Hey, all you cool cats and kittens. Starting up another video, the last video for the week. I'm here with Cora. Hey, Cora. And we're excited to teach you guys all about Unit 4.3. It has to deal primarily with monetary policy. So we're going to get right into it. Big thing to take away 4.3 monetary policy, just as fiscal policy. Monetary policy is the Federal Reserve trying to stabilize our economy through shifting aggregate demand, primarily by influencing whether or not consumers and businesses want loans to influence spending. So both fiscal and monetary policy are shifts in AD, aggregate demand, to stabilize the economy. So we're going to jump right in. Just as a refresher, we talked about this with the money market, right? Where you have the demand for money and the Fed setting the money supply, which is vertical. Well, the Fed influencing the money supply, right, shifting it to the left or to the right, increasing it or decreasing, will in turn shift and change interest rates. The change in interest rates makes loans more or less desirable, which influences investment demand or businesses, whether they want to take out more loans, which is going to influence spending, which will shift aggregate demand ultimately, right? So monetary policy, think the Federal Reserve, how they're going to influence or shift the money supply curve, which is then going to trigger in interest rates, which is then going to trigger whether or not people take out loans, which will ultimately influencing spending, aggregate demand. So you do need to know how monetary policy is going to influence the money supply curve, which will cause aggregate demand to ultimately change. So just in this example, I'm going to get my pointer out. Up here on the top left, we have the money demand curve, the money supply. Sometimes they're seen as SM. I like MS, but let's say the Fed increases the money supply to stimulate the economy, to try and get aggregate demand to increase. And actually, we've kind of seen this. This is what's going on currently. The Fed increased the money supply, which causes interest rates to decrease. So again, here, Fed increases the money supply. Notice the shift, M to M1, M sub 0 to M sub 2. Could be M sub 1 to M sub 2. This causes nominal interest rates to decrease. Because nominal interest rates decrease, investment spending will increase. The quantity of investment increases. Investment spending increases. That'll ultimately cause AD to increase. We should know how AD increasing influences price level, how it influences unemployment, real GDP, that sort of thing. You got to know these steps, okay, and commit them to memory. Hopefully you have this from 4.2, but here you go. So if the Fed decreases the money supply to slow down the economy, well, the money supply decreases up top. The money supply shifts to the left. Money supply shifts to the left. How does that influence interest rates? Well, interest rates increase. If interest rates increase, do loans become more or less desirable? Less desirable. They become more expensive. Well, that's going to cause investment spending to decrease. Well, if the investment spending decreases, aggregate demand will shift to the left. Wait, why would the Fed ever want to slow down the economy? Well, if we're in an inflationary period, right, our economy is cooking too fast, we would want AD to shift to the left to get us back to full employment, to stabilize the economy. It's a funny quote. The role of the Fed is to take away the punch bowl just as the party gets going, in which case it would be seen as a party pooper. But that's the role of the Fed. I showed this hilarious comic a few weeks ago with regards to fiscal policy, right? What tools do we have? What toolboxes to stabilize, to fix the economy, to prevent leaks? That is just fancy terms for getting us back to full employment. So fiscal policy, right? That's actions by who? Congress, which is going to influence spending by consumers, right? The government itself can spend more or less, so the government can manipulate consumer taxes to shift AD And we should know that from Unit 3. The other toolbox which we're going to talk about here is monetary policy. And here are the three tools that it has: the reserve ratio, the discount rate, and the OMO, the open market operations. Either way, both fiscal policy, monetary policy being the Fed, both is going to shift AD or AS. AD, right? Fiscal policy, monetary policy is AD. Well, what will get us back to full employment that isn't AD? Well, AS, obviously, and if it says in the long run or no policy action taken. No policy action taken is saying they're not doing monetary policy. They're not engaging in fiscal policy, right? Well, if they're not doing either, it's not AD that's shifting, it's aggregate supply. Again, this is the AD/AS curve. You got to know it. So here are the three tools. We're going to talk about each in more detail. Again, all of these three are going to influence the money supply, either increase or decrease the money supply, which is ultimately through interest rates, through investments, going to influence aggregate demand. So here are the three shifters of the money supply, and we'll talk about it. Okay, so these are the three tools, the three things that shift it. So the first, the Fed adjusts the money supply by changing any of the following: setting the reserve requirement or the reserve ratio, how much banks are able to hold on to, right? Or they lend money to banks and thrifts. Thrifts is a fancy term for a bank that specializes in loans exclusively. That's a thrift. So how much rate do the Federal Reserve charge other banks? We'll talk about that, which we know is the discount rate. And then the third is open market operations, which real simply is the buying and selling of bonds. Okay. So the Fed is now chaired by Jerome Powell. Just in case AP is not going to ask that, but just good knowledge. Good to have some ideas. So number one is the reserve requirement. And remember, if you have a bank, where is your money? Well, does the bank store all of the money that you deposit in demand deposits? Hopefully from the previous PowerPoint, you realize, no, they don't. They only hold on to a fractional banking, right? They're going to hold on to a part of it. This part that they have to hold on to is called the required reserves, right? The other part that is going to be in excess, that's what's going to be loaned out. So only a small percent of your money is held in reserves. The rest of your money has been loaned out. This is called fractional reserve banking. The Fed sets the amount that banks must hold on to. It's the Federal Reserve that is going to dictate the reserve requirement, or the reserve ratio, as I prefer, that determines how much banks have to hold on to or how little they have to hold on to. So just think of it theoretically. If the reserve ratio is higher, let's say that the Federal Reserve says that banks have to hold on to 50% of any money that is deposited. They increase the reserve ratio from 10% to 50%. Well, the reserve ratio is increasing. Do banks have to hold on to more money? Yes, they do. Well, if they have to hold on to more money, what happens to excess reserves? What happens to the amount of money that it could potentially loan out? Well, if the reserve requirement is increasing, then excess reserves is decreasing. If excess reserves decrease, do banks have as much money that they can loan out? No, in which case the money supply will shift to the left. Again, so if the reserve ratio is increasing, the Federal Reserve is telling banks they have to hold on to more money. That is to say, they can't loan out more money. Well, the money supply will decrease. Money supply shifts to the left, causes interest rates to increase. Interest rates increasing causes investment spending to decrease, which causes aggregate demand to shift to left. So when the Fed increases the money supply, it increases the amount of money held in bank deposits. That is to say, when the Federal Reserve increases the money supply, it increases the amount of money held in bank deposits, as banks keep some of the money in reserve and loan out their excess reserves. The loan eventually becomes deposits for another bank, which they will then eventually loan out. So again, we know this from the money multiplier. And remember the equation for the money multiplier, right? 1 over the reserve requirement. That's how much the money is going to get multiplied within the economy. So here's just an example of the money multiplier. You don't need to take this in notes, but just for the sake of AP Econ, any dollar amount, $1,000, $900, $500 that gets deposited eventually will be loaned out, and it'll eventually be returning back into demand deposits. But theoretically, the more money that gets loaned out, the greater the money supply. So say you deposit $1,000 in your bank. The reserve ratio is 10%. The bank has to hold on to $100. Well, what's it going to do with the $900? Well, that goes in excess reserves. It's going to lend it out. In this case, it lends it out to, of course, Bob. Well, Bob is going to do what? Eventually, Bob's going to deposit that $900 in his bank, right? Maybe not today after he takes out the loan, but eventually he's going to get some money back. He's going to deposit that $900. Well, what happens to that $900? Well, the bank has to hold on to 10% of it, right? That's the reserve ratio. 10% of 900 is 90. It's going to loan out the other 810. And this goes on and so forth, right? Until the money supply just continues to increase through loans. Just think of it this way. The more ability banks have to loan out money, the greater the money supply increases. The more the money supply increases, the more interest rates decrease. Interest rates decreasing causes investment to increase, which causes AD to increase or shift to the right. The opposite is true too. If it becomes more difficult for banks to loan out money, the money supply shifts to the left, causing ultimately aggregate demand to shift to the left, right? So we're creating new money. The money supply increases. Well, how do they do that? Well, it's by manipulating the reserve ratio. So here's our formula for the money multiplier. Remember, the money multiplier was multiplied by the initial increase or decrease in demand deposits, the reserve ratio. The total amount of money supply increases or decreases. Example, if the reserve ratio is 20 and the money supply increases $2 billion, right? How much the money supply, how much will the money supply increase? Well, again, if our reserve ratio is 0.2, 1 over 0.25, 5 times that initial change creates 5 times 2 gives me 10 billion total change. So if there is a recession, okay, think about it in terms of aggregate demand, aggregate supply. If we're in a recession, our equilibrium is to the left or to the right of the LRAS? Well, it's to the left. Well, if it's to the left of the LRAS, to get back to full employment, we would want aggregate demand to shift to the right. In order to get aggregate demand to shift to the right, we would want more or less spending. We would want more spending. I'm going backwards, okay? If we want more spending, it would be a result of interest rates decreasing. Well, if interest rates are decreasing, it's because the money supply has increased. Well, how do we get the money supply to increase? Well, in order to do that, we would do what with the reserve ratio? Well, the Fed would increase or decrease the reserve ratio, right? Well, it would decrease the reserve ratio. If banks have to hold on to fewer cash, what are they going to be able to do with that other cash? We'll loan it out. So decreasing the reserve ratio means that banks have less money that they have to hold on to, that they're required to hold on to, which means that they have more in excess reserves, which means that they can then loan out more money, right? So banks create more money by loaning out the excess. Money supply increases, interest rates fall, aggregate demand increases, right? You got to know those steps. And I know that I've been kind of repetitive when just saying money supply does this, causes interest rates to do this, which causes investment to do this, which causes loans to increase. You got to know that, right? You got to commit that to memory. That is key, okay? The opposite is true. If there is an inflationary period, right, our equilibrium is to the right of the LRAS. We're at 2% unemployment. Our economy is cooking very fast. We want aggregate demand to shift to the left. Shift to the left, aggregate demand. My computer screen's mirrored. I apologize. We're going to want the reserve ratio to increase. Banks, you don't have as much money that you could potentially loan out. Why? Because you got to hold on to more of it, right? So if banks hold on to more money, they've got less excess reserves. That means that less money is being loaned out. Money supply shifts to the left. Money supply decreases, interest rates up, aggregate demand decreases. Okay, that was the first tool, shifting the reserve ratio. Just as a refresher, if we want aggregate demand to shift to the right, we're in a recession, we would want the reserve ratio to increase or decrease. We would want the reserve ratio to decrease. Well done. Okay, opposite is true. Okay, think about that. All right, the second shifter of the money supply curve, right? We're talking about what's going to shift the money supply is the discount rate. Well, just as a refresher from the previous PowerPoint, the discount rate is the rate that the Federal Reserve is going to charge other banks if they fall below their reserve requirement. These are commercial banks, Bank of America, Bank of Brady, Bank of Miss Barr. If the bank of Jerry Deakins falls below the reserve requirement, he can get in trouble. So in order to not get in trouble, he's going to have to borrow from the Federal Reserve. The Federal Reserve is going to charge the discount rate. So if Bank of America needs $10 million, they're going to borrow it from the U.S. Treasury. U.S. Treasury is the Fed. But they must pay it back with 3% interest. Okay? It happens. Although the interest rate is going to be far less. To increase the money supply, right? To cause banks to want to have more loans, should the Fed increase or decrease the discount rate? Let me put it this way. If there was a large penalty for falling below the reserve requirement, like you had to pay 50% interest rate, well, would you be as willing to loan out all of your money that you have in excess reserves? Well, no, I don't want to loan out all of my money in excess reserves because I have to pay a very steep penalty, that discount rate, right? If it's 50%. So to increase the money supply, to cause banks to want to issue more loans, are you going to make that interest rate, that discount rate, scary or not very scary? Well, not very scary, right? If you have a very low discount rate, there's not much penalty for loaning out all your excess reserves and even potentially falling below. So to increase the money supply, the Fed should decrease the discount rate. This is referred to as easy money policy. Easy money, and you might see this term, so I would underline and note. Easy money policy is like making money in loans easily available, encouraging banks to fall below their discount rate to loan out more. Tight monetary policy is the opposite. This is going to make banks less likely. They feel tight. Ooh, I don't want to loan out all my money. I don't want to fall below the required reserve because I have to pay a high discount rate. So to decrease the money supply, right? To get the money supply to shift to the left, the Fed should increase the discount rate to make a very strong penalty for falling below your reserve requirement, discouraging banks to want to loan out their money, causing the money supply to shift to the left, which causes interest rates to increase, which causes investment to decrease, which causes aggregate demand to shift to the left. Okay, remember that manipulating the discount rate is easy and tight money policy. You might see that. This is the most used OMO, the open market operations. And again, very simply, open market operations is just the Federal Reserve buying and selling bonds. Okay. You might see on a test securities. It's just another term for a bond. You don't need to freak out. Okay. So again, it's the most used, the most important. So to increase the money supply, the Fed should buy government securities. Well, who are they buying government securities from? Well, they're buying them from other banks. So Remember this from the previous 4.2b. Bonds act as an asset for banks. You have a bond. Okay. Can you loan out your bond? No, right? It's an IOU. So it's a certificate that is held in the bank. Well, let's say this, the Fed decides that it's going to increase the money supply. Well, how does the Fed do that? It's going to buy bonds from a bank, Bank of America. Well, then Bank of America is giving them the certificates that say you have $5,000 worth of bonds. What is the central bank, not the central bank, what is Bank of America getting in return for the bonds that it's giving up? Well, it's getting $5,000 in cash, right? Well, that $5,000 in cash, that's an asset. That's going to go directly to excess reserves. Well, what can it do with the excess reserves? Loan it out, right? So if the Federal Reserve, just again, is buying bonds, the Federal Reserve is giving the banks money that it can then loan out, that's going to go in excess reserves, in exchange for the certificates that the bank is giving back, right? Giving to the Fed. So by buying bonds, they're allowing the commercial banks, Bank of America, Bank of Brady, to have more cash, which will become excess reserves that it can loan out. The opposite is true too. To decrease the money supply, the Fed should sell government securities. The Fed is selling the bonds to the commercial banks. In exchange, the commercial banks are giving the money from excess reserves. It's not loaning it out anymore, and it's going to buy the bonds with it. Because they have the bonds instead of excess reserves, they're not able to loan out as much money. So here's just another Bradyism to help you remember. If you want the money supply to increase, you're going to buy bonds. I say buy big. Get the money supply to increase, getting aggregate demand to increase. We want our economy to get bigger, to stimulate. We should buy bonds. That is to say, the Federal Reserve is buying those certificates and giving banks more money. What are they going to do with that money? Loan it out. That causes the money supply to increase. That causes interest rates to decrease, which causes investment to increase, which causes aggregate demand to shift to the right. Cool. So you buy big to increase the money supply and you sell small. You're contracting the economy. You're causing, we want AD to shift to the left. We want the economy to get smaller. This is what we're going to do. So buy big, sell small. That is for OMO, open market operations. You with me on that? Well, if you've got that, that's pretty much this unit, this PowerPoint right here. So again, this would be an example of open market operation. You have the central bank, another name for the Fed, right? Well, in this case, to control a recession, if we want to end a recession, we want aggregate demand to shift to the right. We're going to buy bonds. The Federal Reserve is buying bonds. So bonds are going to the central bank in exchange the banks are getting money. What are they going to do with that money? Loan it out, causes AD to shift to the right. Okay. The opposite is true on this other side. Okay. Here is a chance for you to practice. I want you to draw this, to write it in your notes. I don't care if you miss it. I just want to make sure that you have a good attempt. You will potentially see this type or style of FRQ. Again, it's all about how does the money market, the money demand curve, and money supply shift, which causes aggregate demand to ultimately shift. So pause this video, take some practice, and we'll discuss. Okay, pause it. All right, welcome back. Hopefully you feel pretty good about it. Okay, so if you were able to go back in your notes to review, you should have a pretty good understanding. So the central bank of the country of Sewell sells bonds on the open market. Okay, well, we know selling bonds. If we're selling bonds, right, sell small. Well, we're ultimately aggregate demand is going to shift to the left, right? Okay, assume that the banks in Sewell have no excess reserves. What is the effect of the central bank's action on the amount of customer loans that banks in Sewell can make? Well, if they're buying bonds from commercial banks, right? The banks, commercial banks are giving them the certificates. The Federal Reserve, in exchange, giving them money. Where is that money going to go? That money is going to go into excess reserves. What can they do with that money? They're going to loan it out. So what's happening to the amount of money that customers or the bank can loan out? It's increasing, right? Excuse me, the opposite. The country bank sells bonds. So if they're selling bonds, it's causing the money supply to shrink. They're giving the commercial banks, I apologize, they're giving the commercial banks the bonds, right? In which case they're taking the cash from the commercial banks. If they're taking cash, the central banks have less, or the commercial banks have less money that they can loan out. So 1 point is earned for stating that bank loans will decrease. Okay. Well, using a correctly graph of the money market, show the effect of the central bank's actions on the nominal interest rates. Well, again, here you go. If they're selling the bonds, the money supply shifts to the left. That causes interest rates to increase, right? So what is the effect of the central bank's actions on the following in Sewell? Price level. Just think, what graph tells us about price level? Well, hopefully you remember the aggregate demand, aggregate supply curve. Price level is in that. That is code for how does the money market and this influence, the monetary policy influence the aggregate demand, aggregate supply curve. Well, again, remember, buy big, sell small. If the central bank is selling, the money supply is decreasing. The money supply decreasing will ultimately cause aggregate demand to do what? Well, aggregate demand is decreasing. If aggregate demand decreases, right, what happens to price level? And if you're not certain, draw it out. I kind of did here. So here's your example. Aggregate demand decreases. Hopefully you can see this. Causes price level to decrease. If price level decreases, real wages have increased. But there you go. So price level is decreased. What happens to real interest rates? Well, here you got to use that real interest rate formula. So if you don't have it, commit it to memory. Real interest rates equals nominal minus expected. Real interest rates equals nominal minus expected. Well, look what's happened to nominal interest rates. Nominal interest rates have increased. Nominal interest rates are the rates that the bank charges its customers. So nominal interest rates have increased, right? Meaning that loans are more expensive. That causes real interest rates to ultimately increase. 1 point is earned for an explanation that with an increase in nominal interest rate and a decrease in price level, the real interest rate increases. Use that formula. Real interest rate equals nominal minus expected inflation. The nominal interest rate is the rate that the bank charges its customers. The real interest rate is determined by whether or not the bank wins or loses on its loan. If it's a positive value, that is a win for the bank. If it's a negative real interest rate value, that is a loss for the bank. Now, price level we can equate to inflation. Inflation has gone down, right? So either way, nominal interest rates increasing, inflation decreasing, both is going to cause real interest rates to increase. And just given your answer in part C, how is the international value of Sewell's currency, the ONO, affected? You don't need to know this, but if price level has decreased, right, does their currency become more valued? 1 point is earned for stating that the ONO will appreciate because the increase in demand for Sewell's financial assets causes increase in the demand for the ONO. You don't need to know that, but I can explain it to you if you'd like. Here's another practice. So you should have the means to answer it. Pause this video and go ahead. I want to see this in your notes for when you turn it in. Ready? Go. All right, let's bring it back and let's discuss. Thank you guys for taking that time. A drop in credit card fees causes people to use credit cards more often for transaction and demand for money. Well, what curve are they talking about? Well, they're talking about the money market graph, right? And specifically the demand for money. So you've got to draw the money market graph. So if people are using more credit cards, what's happening to the demand for money? Well, the demand for money is shifting to the left. People want less money on hand. Well, if the demand for money is shifting to the left, what is happening to interest rates? So using a correctly labeled graph of the money market, show how the nominal interest rates will be affected. Well, here you go. The demand for money decreases. That causes nominal interest rates to decrease. 1 point is earned for a correctly labeled graph. Make sure you know the axes. 1 point is earned for showing a downward shift in the money demand curve and showing a decrease in nominal interest rates using arrows, labels, or dotted lines. I like the dotted lines. Given the interest rate change in part A, what will happen to the bond prices in the short run? Well, what's the relationship between interest rates and bond prices? Well, they're inversely related. I told you, remember that. Okay, AP loves to ask this. Well, if interest rates have decreased, what's going to happen to bond prices? Well, bond prices will increase, right? 1 point is earned for saying that bond prices will rise in the short run. They're inversely related. Given the interest rate change in part A, what will happen to price level in the short run? Price level. What graph tells us about price level? Oh, ADAS. Well, if interest rates have decreased, does that make loans more or less enticing? Well, they make it more enticing. Ultimately, aggregate demand will shift to the right. Aggregate demand shifting to the right causes price level to do what? Causes price level to increase. So again, 1 point is earned for stating, this is C, that price level will rise. 1 point is earned for the explanation that the price level increases because aggregate demand increases, and aggregate demand increases because interest-sensitive spending, right? This is talking about loans, increases. Cool? Identify an OMO, open market operations. Remember, open market operations refers to the buying and selling of bonds. Identify an open market operations the Federal Reserve could use to keep the nominal interest rate constant at the level that existed before the drop in credit card fees. It's a fancy schmancy way of saying, what can we do to get aggregate demand to shift back, to get back to where we were, to get back to full employment? Well, remember, previously we're talking about aggregate demand increasing, right? Because interest rates decrease. So in this case, we want aggregate demand to shift to the left, to reverse that. Well, what will cause aggregate demand to shift to the left? Open market operations. Are the Fed buying bonds or the Fed selling bonds? Which is going to cause AD to shift to the left? Well, buy big, that's going to cause AD to shift to the right, so we don't like that. Selling bonds, right, causes aggregate demand to shift to the left. 1 point is earned for saying that the Fed could sell bonds to decrease the money supply and raise the interest rates back to the original level. Hopefully you did that. That's 6 points. Bink. Well done. Okay. Another couple questions for you. Pause this video and answer them. Pause. Back to it. Cut. If the reserve requirement is 25%, that is to say banks have to hold on to a quarter of every dollar that gets put in, and they have no excess reserves. If the open market sells, selling, is that causing increasing or decreasing the money supply? It decreases. So we should know that, A, C, and D are eliminated. How much will it change? Well, again, it's the multiplier times the initial change. Well, what's our multiplier? 1 over 0.25. How many quarters in a dollar? 4. 4 times 400,000. That should decrease the money supply 1.6. Hopefully that's the case. Let's check. Oops, it did it in reverse. But here you go. To counteract a recession, we're on to the second. The Federal Reserve should buy bonds. Securities is a fancy term for buy and lower the discount rate. So you may see problems like this where, because it's an FRQ, they might ask you specifically, what should the Federal Reserve do? And we're talking monetary policy, Federal Reserve monetary policy, right? The 3 tools. discount rate, reserve ratio, OMO, open market operations. If they're talking fiscal policy, we're talking Congress, we're talking spending by the government, or influencing consumer spending through taxes. So don't forget it. Oops. The purchase of bonds, you didn't see that. The purchase of bonds by the Federal Reserve, buying bonds, will have the greatest effect on real GDP if which of the following situations exist in the economy. Well, the reserve ratio is high. No, because they can't loan out as much money. So we know A is wrong. The reserve ratio is high. Again, no, we don't want the reserve ratio to high. We want them to be able to have more money. We want a greater multiplier. The reserve ratio is low, so that could potentially be it. And the interest rate has a large effect on investment spending. Well, if the interest rate has a large effect, we know that by lowering interest rates, it's going to cause more people to want it. That's the answer. But let's just double check and make sure the others don't really work. The marginal propensity to consume is low, right? We want high MPC. We want more spending, more of that money circulating within the economy. The marginal propensity to consume is high. Okay, that's good. And the interest rate has a small effect? No. So that's the reason right there. C is correct. Okay, how about this one? Remember, what is the relationship between bonds and interest rates? Pause it, go over it. Okay, welcome back. Well, in the short run, which of the following would occur to bond prices and interest rates if the central bank bought bonds through the open market? Well, if they're buying bonds, the money supply is increasing. Buy big. The money supply is increasing. What happens to interest rates? Well, interest rates are decreasing. So C and E are our only potential answer because interest rates are decreasing. Well, remember the relationship, they're inversely related. So if interest rates are decreasing, bond prices must increase. I hope that's the right answer. Bingo. Good. All right. So don't forget the money multiplier, right? If the reserve requirement is 0.5 and the Fed sells 10 million of bonds, is that increasing or decreasing the money supply? Well, it decreases. If the reserve requirement is 0.5, 1 over 0.5, how many 50-cent pieces in a dollar? 2. What will happen to the money supply? It'll shrink by 20. So pause it, answer the rest of these, okay? So the answer here is what will happen? The money supply decreases 20 million. If the reserve requirement is 0.1, well, then our multiplier is 10, and the Fed buys million bonds. Well, buying is the money supply increasing. It's increasing. What will happen? 10 times 10 gives us 100 million. If the Fed decreases the reserve requirement, if they decrease the reserve requirement, do banks have to hold on to more or less money? Well, they have to hold on to less money, which means that more money is going in excess reserves, means that more money can be loaned out. The multiplier is increasing. Just in this case, look, if it's 0.5, that's 2. Now it goes to 0.2, that's 5. Lowering the reserve ratio increases the multiplier. So remember, the federal funds rate is the rate that other banks can charge each other. The Fed doesn't necessarily decide the federal funds rate, but it has an incredible influence in shifting it. So by the Fed lowering its own interest rates when banks fall below the discount rate or the reserve ratio, by lowering the discount rate, well, it's going to incentivize. It's going to cause other banks to want to go and shop at the Fed as opposed to other commercial banks. So in order for those commercial banks to still be enticing, to still cause people to want to buy their loans from them, they're going to have to lower their own interest rates. So the Fed influences them by setting a target and using open market operations to hit it. The federal funds rate fluctuates due to market conditions, but is heavily influenced by monetary policy, the buying and selling. So here you see the change in federal funds rates. You'll note today the rate that other banks charge each other is very low. They're trying to entice you to fall below your reserve ratio. That is to say, to loan out your money, right? We were in a recession in 2008. Well, how do we combat that recession? We get AD to shift to the right. We want to influence more spending. We want to influence more banks or businesses to take out loans to spend. We lower the discount rate. We lower the federal funds rate to make money cheap. And we saw this just recently. To fight the coronavirus, our Federal Reserve has historically lowered the interest rates to be incredibly low to try and get more people to take out money, to take out more spending, to cause AD to shift to the right. All right, this is your last practice problem for the PowerPoint. I want to see this in. So go ahead, pause it, pause. We'll come back, we'll answer it. Okay, welcome back. Let's go over it together. Want to see this in your notes. Assume that the U.S. economy is in long-run equilibrium. That's fancy terms for we're at full employment with an expected inflation rate of 6%, an unemployment rate of 5%. The nominal interest rate is 8%. Good. So using a correctly labeled graph with both the short-run and long-run Phillips curve and the relevant numbers from above, show the current long-run equilibrium as point A. Okay. I like the Phillips curve, but I love the aggregate demand, aggregate supply curve. So to help me better understand the Phillips curve, I'm going to draw in with this the ADAS, right? So I know what aggregate demand, aggregate supply curve looks like if I'm in full employment. Here's where you got to this was unit 3 we're talking about. So going back, you got to be able to make the graphs speak with each other. So you drew your Phillips curve. You should be at the LRPC, the long run Phillips curve. We're at full employment. You indicated you have the proper axes, unemployment rate on the x-axis, inflation rate on the y-axis, the correct numbers, the dotted lines. Excellent. Calculate the real interest rate in the long run equilibrium. Well, what's the formula? Real interest rate equals nominal minus expected. So the real interest rate equals 8, nominal interest rate, minus expected inflation, 6. 8 minus 6, that's a positive 2 real interest rates. Just for our own sake, if the reserve or the real interest rate is positive, that's a win for the bank. So that's B is 2%. Assume now that the Federal Reserve decides to target an inflation rate of 3%. What open market operations should the Federal Reserve undertake? Well, let's just again relate it back to our aggregate demand, aggregate supply curve. Inflation, we know, is best indicated by what on the aggregate demand, aggregate supply curve? It's the same y-axis, price level, right? So in this case, we want price level to fall. We want price level to decrease. Well, if they're talking the Federal Reserve acting, is it AD or AS that's going to shift? It's AD. So how do we get aggregate demand? How do we manipulate aggregate demand to cause price level to decrease? Well, we would want aggregate demand to shift to the left. Okay? So what open market operations will cause aggregate demand to shift to the left? Remember, OMO, open market operations, is the buying and selling of bonds. What is the phrase that I want you to remember to how it stimulates the economy? Buy big, sell small. So in this case, we want the economy to contract. We want AD to shift to the left. Well, what causes AD to shift to the left? We're going to sell bonds. Okay, let's just make sure we're all together. So again, here's my Phillips curve. I've got properly labeled. The axes are correct. I've got A at the LRPC. Again, those are free points. 1 point is earned for the correct calculation. Real interest rate equals 2%. Now, if you just wrote 2%, you're going to get points. But I would just show the formula. I think you demonstrating that you know your econ, that's just going to allow the reader to say, oh my goodness, this guy really knows what he's talking about. 1 point is earned for saying that the Federal Reserve should sell bonds. Remember, we want AD to shift to the left. We want the inflation rate to decrease. So if we want the inflation rate to decrease, right, we're going to be here. Well, movement along the aggregate demand curve to the right is a result of aggregate demand shifting to the left. Remember, Phillips curve and aggregate demand, how they relate to one another. Okay, we did A, B, and C. How many people are full points on this? Good. Like it. If you're not, that's okay. Just go back and make sure that you understand why and how you'd fix it. Using a correctly labeled graph of the money market. Oh my goodness, and now we've got a third graph. ADAS, Phillips curve, money market. Good, bring it on. We love the challenge. This is a number one PowerPoint or FRQ. It's one of the big boys. You will have to do a big boy on your FRQ for sure. Using a correctly labeled graph of the money market, show how the Federal Reserve's actions you identified in Part C will affect nominal interest rates. Easy, right? Money demand, money supply. Well, if they sell, the money supply is shifting to the left. To the left, money supply shifts to the left, causing nominal interest rates to increase. Okay. How will the interest rate change you identified in Part D affect aggregate demand in the short run? We already went over this. Well, if nominal interest rates increase, does that make loans more or less expensive? More expensive. If they're more expensive, does that help or hurt people to take out loans? It hurts. Aggregate demand shifts to the left, right? In either case, if we're at full employment, which we were in the beginning, right? Aggregate demand shifts to the left, right? Where are we operating now in our economy? Well, hopefully you said we're operating in a recession, right? Now, your explanation in Part E should go over those steps about investment spending and interest rates and how it influences. Anyway, so from E and F, we're in a recession. So assume that the Federal Reserve action is successful, meaning we're in a recession. What will happen to each of the following? So by that I mean Federal Reserve action is successful. What happened in D or C and D was correct. It happened. That's where we're currently operating in the economy. We're in a recession. What will happen to each of the following as the economy approaches a new long-run equilibrium? Again, what's that code I want you to think of if it says in the long run? Is that AD or AS if it's in the long run? Well, if it's in the long run, it's aggregate supply, AS. So if we are to the left of the LRAS, right, in the long run, how does aggregate supply shift to get us back to full employment? Well, the aggregate supply curve would shift to the right. Remember, how does that influence? I'm on FI. If the aggregate supply curve shifts to the right, that would cause the SRPC, the short run Phillips curve, to shift to the left. Right there, inverse, their mirrors with each other. So 1 point is earned for a correctly labeled graph in the money market. 1 point is earned for showing a leftward shift in the money supply, causing nominal interest rates to increase. 1 point is earned for saying that the aggregate demand decreases. 1 point is earned for explaining that higher interest rates, nominal interest rates have increased, causes investment to decrease, right? Which then triggers aggregate demand to decrease. 1 point is earned for stating that the short run Phillips curve will shift to the left. Well, in order to get back to full employment relating to the AD and AS, remember aggregate supply shifted to the right. If aggregate supply shifts to the right, the short run Phillips curve will shift to the left. 1 point is earned for explaining that the Federal Reserve policy will lower inflationary expectations. I would say something about wages in my example, right? Why in the long run does aggregate supply shift to the right? Well, it's because wages decrease, price level matches wages decreases, helps businesses, helps production, aggregate supply shifts to the right. Well, how about FII? What's going to happen to the natural rate of unemployment? We should note the natural rate of unemployment only changes. They're trying to trick you with that. The only thing that changes the natural rate of unemployment is unemployment benefits. Does anywhere in this talk about unemployment benefits? No, right? the natural rate of unemployment, that is to say full employment, stays the same. The LRAS doesn't shift. So there you go. Cool. I've got another practice for you. I'm going to allow you guys to kind of practice on your own. I want you to try. There is going to be more FRQs. Your final, your econ test is totally FRQ based. So I would practice. This is a relatively easier one. It's straightforward. So the answer is there. Practice. I've got other means for you to practice should you want. I'm not necessarily requiring you to do this on your notes, but again, I would appreciate you doing it. There's a Mr. Clifford video here that can help you. There's an additional banking problem with answers. I know some of you were struggling with that. So use this as an opportunity to practice. I'm not necessarily going to be expecting it in your notes, but it would be nice to see. I'm not having you guys do any summary on your ed puzzles because I want you to have more opportunities to practice. So hopefully this makes sense to you. Again, just big ideas. How do those 3 Federal Reserve tools, we're talking influencing the discount rate. We're talking about influencing the required reserve, talking about open market operations, knowing what, if they increase, decreases, how it affects money supply, which in turn affects aggregate demand. That's it pretty much for this. Hopefully you guys get it. Come talk to me if you're struggling. I'll do my best to answer any questions. Otherwise, all the best to you. Good luck.